making no money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Been check to check, you know, and it could be different, you know.
What's going on, profiteers? Hope all is well. Another episode of your convo with your CFP, Mario Payne. 16 years in the game. Been a certified financial planner since 2013. You don't see a lot of me's as a certified financial planner, especially with the swag. But before we start, comment, share, subscribe to our channel. Also, if you're an investor, you got to be an investor if you watch, right? We have our own investment app, Let Bob, Letbob. It's on the App Store. It's on the Play Store. You can download it. The great thing about the app, from an educational standpoint, we educate you before you invest. We stop you maybe from investing if you buy something. And also, we allow you to be notified when the best time to invest when you pick the stock that you want to pick. Also, you get notifications. Whatever stock that you like, you get notified on a day-to-day basis or weekly, depending on how you want it, what's going on with that stock, and just basic news, because our motto is financial education and financial literacy is the key. It does not stop there, though. We also have our ETF, LET, B as in boy, Let Be. Third Black-owned ETF on the stock market, and the first Black-owned ETF on the stock market that's fully AI-powered. Automation is the key. But today, we're going to have a conversation about what I had from a conversation standpoint with a client. And they wanted to know, it is tax time, right? We have up until the 18th to file our taxes. If you are a business owner, you have up until September, a little bit more wiggle room to extend. But the conversation was, I want to put money in for 2022. You can for 2022 up to April 18th. But the question was, Mr. CFP Mario, Roth IRA, traditional IRA, which one should, oh, you like that. Which one should I do? So let's talk about the pros and cons of a traditional IRA and a Roth IRA, and what's the biggest bang for your buck. Let's go, profiteers. Well, first off, the main difference between a Roth and a traditional. Let's look. The difference is a Roth IRA and a traditional IRA is basically how when you get taxed. And what's that breakdown? Contributions to traditional IRAs are tax deductible. What does that mean? We made $100,000. We put $5,000 in our traditional IRA. From a tax standpoint, we're not taxed at $100,000. We're taxed on $95,000. Tax deductible. Now, what's the difference between a tax deduction and a tax credit? You receive a tax credit of, let's say, $5,000. Then Uncle Sam is giving you, boom, $5,000. That's a credit. A tax deduction from your salary. Again, we made $100,000, put $5,000 in our traditional IRA or our 401k or our deferred comp or 403b. Then instead of being taxed at $100,000, we're taxed at $95,000. That is tax deductible. Go back to the screen. But withdrawals in retirement are taxable. In comparison, contributions to your Roth IRAs are not tax deductible. So that Roth IRA, that Roth 401k, we put $5,000 in that. We make $100,000, we're still being taxed on $100,000. We're not deducting anything. However, let's look at the screen. But the withdrawals in retirement are tax-free. Caveats. Got to be 59 and a half. We don't want that 10% penalty from the IRS for taking it out early. Or investment hack for y'all. Listen. When it comes to a 401k, if you've been with your company for more than 10 years and you're age 55 or older, when you take out that money, no 10% penalty. Now, a traditional 401k, got to pay taxes. A traditional IRA, you don't get that investment hack because it's not through your employer. Sorry. A Roth 401k, yes. Tax-free and penalty free because we're 55 and been with our employer for more than 10 years that we left from, I take that. Roth IRA, not so much. And it's also the 5-year rule as well. So a lot of things to consider between a Roth IRA and a traditional IRA. But let's look at some more. And shout out to NerdWallet for this great information. I always say education is the key. So that could be Investmentpedia, that could be NerdWallet, that could be our app Let Bob that gives you a lot of information from a financial literacy standpoint. Before you make any decisions, though, you want to do your research. And then talk to your local CFP like yourself, myself, not yourself, or we have CFPs watching this, of course, as well, like myself, to give you information so you can make a detailed decision about your pockets. But what's the differences? Let's look. From a Roth IRA standpoint, no immediate tax benefit for contributing. Again, we put in $100,000. That $100,000 is what is on our taxes. Nothing less than that. So no tax deduction. Contributions can be withdrawn at any time without taxes or penalties. Think about that. Any time without taxes or penalties. They do have a 5-year rule though, right? Have to hold it for 5 years. If not, then Uncle Sam might be knocking on your door. So make sure we hold that for 5 years. And that's why it's key from a budgeting standpoint. We always talk about saving and investing. We got $100 of discretion income and we want to do something with it. Does not mean we put all $100 in investing. Maybe it's half and half. Maybe it's 75-25. Maybe it's 60-40. But this is why it's important to save and invest. Because if you need money, it's in a Roth IRA over that 5-year time period. IRS might be coming knocking on that door. And we don't want the IRS to come knocking on that door, do we? I mean, they just hired another 80,000 agents? So it's more people to knock. Nothing against the IRS though. They need to collect money. Because if we owe taxes, we should pay them. But let me get off my high horse or my soapbox. Which one? We don't know. Let's go back though. The ability to continue is phased out at higher incomes, meaning the more money that you make, the less you can put in to your Roth IRA. And qualified withdrawals and retirement are tax-free. So again, from a tax standpoint, put in $100,000, let's say it's now worth $200,000 and you're age 60. You're past 59 and a half. So all $200,000 you take out, we don't pay a lick in taxes. Pretty cool. Pretty cool. I made $100,000 and I had to pay Uncle Sam only in America, in the words of Don King. But that's a Roth IRA. Let's go to a traditional IRA. If deductible, contributions reduce taxable income in the year that they are made. As I said before, got $100,000 salary-wise, $5,000 in our traditional IRA. From a tax standpoint, I'm only paying taxes on $95,000, not on $100,000. Tax deductible, putting money in our pockets. That's always a good thing. Let's look below. Deductions can be phased out depending on your income. So the more that you make, those deductions go down and down and down and down. Distributions in retirement are taxed as ordinary income. This is a biggie. We got capital gains, ordinary income. As it stands right now, let's say we made $100, bought something for $100. Now it's worth $200. We sold that investment in our regular investment account. We made $100. After 1 year, that's a capital gain. A capital gain is when you pay 15% in taxes. Made $100, $15 goes to the IRS, $85 goes to us. That's a capital gain. Ordinary income, a little bit different. Ordinary income is what an income bracket is. So let's just say hypothetically, we're in the 25% tax bracket and we take money out of our IRA. Since it's taxed at ordinary income, I made $100, $15 doesn't go to Uncle Sam, $25 do because I'm in the 25% tax bracket. So $100, $25 goes to the IRS, $75 goes to me. But wait, it gets worse. Think about this. Ordinary income also means income. And income means it's going on your 1099 when you pay taxes. So let's use that example of $100,000. Got $100,000. but now I took money out of my IRA at $1,000. Well, that $1,000 is like I punched the time clock somewhere, swipe that card, right? Or hit that buzzer, depending on how you get to work. I made $1,000. So now I did not have an income of $100,000. I have an income of $101,000 because it's ordinary income. It counts towards your taxable income. So not only did I pay taxes when I took the money out the IRA, but it counts as income. So if I made more money or in another tax bracket, I got to pay back taxes. Uncle Sam's knocking on my door. People say all the time, "Where Mario? Is that double taxation?" No, it feels like it's double taxation, but it's not double taxation. It just means that from a tax standpoint, since you have ordinary income, it counts towards your income. It's like having two jobs. You make $50,000 at one job, $50,000 at another job. That's $100,000, right? $100,000, $1,000 from an income standpoint, taking money out of your retirement plan after 60 with no penalties. That's $101,000. So something to think about. Also, with the traditional IRA, let's look at this from NerdWallet. They are a required minimum distribution once you hit a certain age. RMD. I get those calls all the time from our more mature age clients. "Mario, I don't want to take money out. What can I do?" Well, by law, you have to take money out. And the reason why you have RMD, which is called required minimum distribution, is because the IRS knows if something happens to you, you have a beneficiary. So that money goes from you to your beneficiary. They ain't paying taxes on that when they first get it. Now, once they take the money out, they paying taxes. But that first transfer, a person passes away, is no taxes. But if you got to take it out while you're living, they want that tax money. They don't want to wait till somebody else takes it out. They want you to take it out. It used to be at 70, but now it got increased to 72. Typically, it's about 4 to 5% when you first hit 72, but as you get older, it goes up. So as you can see, it increases at 73, and then at 75, it continues. So if I got $100,000 in my IRA or in my 401k, that's traditional, not Roth. That is traditional. Then guess what? We got to take out at least 4% or $4,000 out of our IRA every single year. Now, if you don't need the money, I typically recommend just put that into a investment account or a savings account or investment hack, send it to a charity, right? A lot of times you can do what you call an in-kind distribution to that charity. Take it out from R&D standpoint, give it to the charity. We got to pay taxes, but it goes to the charity as a tax write-off. And if it's in kind, if that investment grows and that charity gets the profits, painful profits, but profits because it grows. So those are some things to think about. Man, I'm dropping jewels today. Combos with your CFP does not get any better. Let's look back below. Contribution limit, $6,500 in 2023. $7,500 if age 50 or older. So it is a limit. If we make $100,000, we can't put all $100,000 in the Roth. We can't put it all into the traditional IRA. You have a max, and that max is $6,500. Now, if we're 50 or older, IRS, they say, you know what? You could do more. You can do $7,500 in the Roth or $7,500 in a traditional IRA. Food for thought. Last thing to talk about before I leave y'all for today, early withdrawal rules. And yes, it's penalties. If we take it out before age 59 and a half, as I said, a Roth IRA, you get that 10% penalty. Take out $100. Uncle Sam says, give me that $10 because you're not 59 and a half. Traditional IRA, 10% penalty. If I'm not 59 and a half, you gonna get it. So just remember, when we put money into our traditional and Roth IRA, long term. And again, that's why as a certified financial planner, even though we love investments because your money grows over time, theoretically, you still want to put money in savings for a rainy day or worst case scenario. But with that being said, hopefully that gives us some information when it comes to Roth IRA versus traditional IRA. Wait, Mr. CFP, which one's the best? Well, it's up to you. Two trains of thought. You want a tax deduction now? If so, do the traditional IRA. Now, of course, over time, when you take it out, you're going to pay more taxes, right? Put in $100 or $100,000 over the years. Now that $200,000 I take it out, I'm taxed on $200,000. I got $100,000 of tax deductions, but I'm paying $200,000 in taxes. Or you say, well, you know what? I don't know what taxes will be down the road. Let me pay taxes now. That's when you do a Roth IRA, because when you put in $100,000, you don't get no deduction at all. But it grows to $200,000. You take it out after age 60, you have $200,000 of tax-free money. My personal opinion, what I recommend clients do the Roth IRA, because over time, from a compounding interest standpoint, I will get tax deductions now, yes. But when I take out the money, it'll be way less money in taxes I have to pay. And if it's way less in taxes I have to pay with compounding interest, because over time you have more money, that's more money you don't pay taxes on. Let's do the Roth IRA. Just my opinion, but that's why we do what we do, and that's why we make recommendations. Like a doctor, you don't got to take my medicine, but prayerfully I gave you a good checkup. But comment below. We're in a Roth IRA, we're in a traditional IRA, SEP IRA if you're a business partner. That's going to be another episode. All is well, though. Stay healthy. And as always, let's make some payroll profits together, y'all. Peace.
And you just wanna get paid. Tired of making no money mistakes. Make a payment on your bills and you still late. Yeah, paying for profits to help you seek change.